This content is brought to you by iTrust Capital, which is a great platform that allows you to easily invest in crypto without worrying about taxes or fees. iTrust Capital allows you to invest in crypto through an individual retirement account or IRA. IRAs are tax sheltered accounts, which means all of your crypto is tax-free and can even grow tax-free over time. The process of signing up with iTrust Capital is very easy. They have a mobile app. They have 25 plus cryptocurrencies. They have full support, a dedicated team ready to help you. And it is free. And once again, 100% free to sign up with iTrust Capital. There are no hidden fees and there's no monthly subscription or membership. They also have great security. They utilize Coinbase custody for all their custodial services. So you don't have to worry. It is institutional grade crypto custody that they are using. This is a great platform. Once again, it is free to sign up. So visit the link in the description and go check it out. If you sign up with my link, you get a $100 funding bonus. So once again, check the link in the description. Welcome back to the Thinking Crypto podcast, your home for cryptocurrency news and interviews. With me today is Greg Dickerson, who's an entrepreneur, real estate developer, coach, and mentor. Greg is no stranger to the show, so welcome back, Greg.
Hey, Tony, good to be back. Thanks for having me.
Well, Greg, it's brutal out there. All markets seeing red, and I certainly want to get your thoughts and perspective, some of which we've been talking about over the past maybe 4 to 5 months since you've been joining the show here. Let's start with crypto because we have something big with the Terra LUNA stablecoin collapse. What is your thoughts on what's happening with the crypto market?
Yeah, I mean, that's amplifying what has already begun. So, markets are going through a deleveraging overall. So it started in financial markets with the Fed, pulling the foot off the gas, raising interest rates, starting their QT program and signaling to the markets that we're not going to bail you out. So that's the messaging coming out of the Fed right now after the last meeting when they hiked rates 0.5 point. So what we saw leading up to all these things was deleveraging. So once the market started to deleverage, now they have to reprice. So repricing means what's a fair valuation for these assets. Now, crypto isn't necessarily a pricing mechanism. It's more speculative completely versus stocks that are priced on, earnings or future earnings or performance, things like that. So there's some traditional metrics used there that just don't apply in crypto. So at the end of the day, crypto has been more of a speculative cycle where, there's a consolidation period, market makers and whales start marking the price up, retail gets involved, a big FOMO, you get the blow off top, falls, a couple little bounces along the way, and then tails off and, consolidates again for a number of years. And that's been those 4-year cycles. And if you look at, the total altcoin market, you look at Bitcoin, and then personal experience that I've been following the markets since 2016, didn't start investing in crypto until 2020 at the bottom, March of 2020. So I've been heavily involved ever since then. Those are the cycles it goes through and it's just hype. There's no fundamentals behind most of the cryptocurrency altcoins. There's obviously some fundamentals behind Bitcoin in terms of what it's supposed to be ultimately, which is a digital gold. I look at it as digital real estate. To me, it's like digital property coming from the real estate industry. That's kind of how I view Bitcoin. It's like a house, or like a building, but digitized and from a speculative standpoint, buy low, sell high. That's what I've done my entire career, merchant developer. I build and sell, I buy, renovate, sell, those types of things. So for me, I buy Bitcoin low, sell it high, and I do it over and over and over. So that's kind of how I view it. To me, it's not a store of value. And obviously it's proving that it's not. It's too volatile right now. It needs a little bit more time. Now, let's talk about altcoins. Altcoins are different. Some of those are obviously like Ethereum, is an altcoin. Some people don't view it as an altcoin, but anything that's not built Bitcoin's an altcoin.
Right.
Ethereum is, has a lot of projects built on it. It's got more of a use case than, a lot of the different altcoins and, including what's going on with, Terra LUNA right now and the algorithmic stable coin that is a perpetual motion, algorithm that is supposed to be self-sustaining, but it's not. And, it's failed before. And now it's come out that Do Kwon, the founder, has done this before under a pseudonym with somebody else. So, it's really interesting what's coming out and what's going on with this thing. And obviously it lost its peg, and, Terra's, nosediving. So that just kind of amplified what had already started. We're already in a bear market. We're already consolidating. We're already trying to find a bottom, in terms of where this is ultimately going to go. And there's some theories and thesis on whether or not it's going to break these levels of last summer. But I think that just amplified things. And it's obviously, money coming out of the markets and creating panic in other altcoins. But you kind of need this to happen, right? There's thousands of altcoins that have no use at all. They're just totally speculative gamification type things that just need to go away. So, you kind of need these markets to kind of clear out the trash. And then, the top altcoins that have a real use case, like your Solana and your, Cardano, arguably, some people will say it does, some, it hadn't really done anything yet. Ethereum, Avalanche, Link, crypto.com, Coin, Proppy, some of those have real companies behind them,
right?
That have use case. So that's kind of where we're at, just cleaning out the trash.
So, are you anticipating any type of retracement, or do you think this is it? We're tumbling down into that deep bear market, whether that lasts or has the same length, as far as timeline as it did in 2018 to 2019, or things start to, recover later this year or next year. What are your thoughts on the short-term outlook?
Yeah, I think the theory and thesis that we talked about, the past couple of episodes is playing out, where the top was actually the 64,000, April, May top in 2021. And then we had that July 2021 low. And then we had an irregular retracement correction that went beyond normal levels to reach that November, December high. And we had our alt season during that period. So the alts fired off, back in after last summer. We had the DeFi summer and the Metaverse and all that. So it went large cap, DeFi, Metaverse, small caps, and now we're, on that backside bear market consolidation. So I don't think you're going to see any kind of a retracement for altcoins. Alt season already happened last summer, and I think right now we're in that downward consolidation. And to me, where we're at right now looks a lot like where we were in 2018, after the top there, as we worked our way down towards that final capitulation bottom. So I don't think we've seen a final capitulation yet to the bottom on most of these, because a lot of the altcoins are still, well off of their lows where they were before March 2020, pandemic. And so that's kind of where I think you got to get back to on a lot of these. And even the total altcoin market, when you look at that, it still has about probably 60% from here that it needs to go down and can go down before it starts over again into a consolidation.
So, as far as your strategy, are you kind of in a holding pattern? I know you pretty much swing trade, but are you trading at this point, or just waiting to see where this market goes and where the bottom settles in?
Yeah, I'm in a trade right now. So I've been kind of getting in and out. I've moved on a couple of things in and out while it's been, dropping, because you're getting the dips and the pumps, So in the bear market, buy the dip, sell the rip. But you got to be careful, because right now, those dips are pretty deep, so you got to look at that risk reward. And, I was tempted to do something with, UST and with, Luna, but I just use crypto, or I use Coinbase. So I can't buy Luna, it's not on Coinbase. But man, you could have made a nice little hit on that today, but it's dangerous, because that is one that can go to zero and go away. And it's on the verge of potentially doing that. UST, I don't know what's going to ultimately happen, but it doesn't seem like it's been able to regain its peg yet. So I don't know that it will be able to.
Now, we've seen crypto has been highly correlated to the stock market, and the Fed has plans to continue to raise rates. However, I saw this past week, some folks were talking about they may not be able to raise it the amount of times that they are planning to. What are your thoughts on that? Do you think that we might see a couple more times or 10 more times? And, at some point later this year or next year, they're going to have to start pumping markets again, printing more money and start doing QE?
So I don't know about the timing.
Mm.
It all depends on inflation. So the Fed is going to continue on this path until something breaks. And what something breaks means we get a big crash in the markets, 50% or more down. They're definitely not going to step in. They're signaling now, their messaging is pre-pandemic levels is where they feel like the markets should be from a fair valuation. They're not even going to think about stepping in until you're back to that point and then down from there. So that's about 50% below where where the peak was, and probably, the markets are at different levels, so I'd have to look and see where it would be percentage wise down from here. But the Dow is only down about 15%, I think, if it's even down that far right now. 10 to 15. Nasdaq's taking the biggest hits, probably down 25 now. S&P's in that 20 range. So until they get down 50% from the peak, which puts them about where they were pre-pandemic lows, that's when the Fed probably perks up a little bit. But their mandate is stable prices and full employment. So they have to either break the stock markets, break the labor market, or break inflation. And if nothing else in the markets, like credit markets or the stock market, gets a major crash or disruption, they're not going to pivot and change course. So I don't know how long that's going to take. It just depends on how long it takes to get inflation back in check. And they're going to let the markets run down, and that's their messaging that they've signaled, and everybody's speaking over the last couple of days.
There are some who think that maybe, and this is a maybe, right? We're just speculating with the midterm elections coming up, that look, there's a bit of politics at play here. Could the president, trying to help the Democrats and so forth, push the Fed to make the markets look good, at least heading up to those midterm elections? Any thoughts on that, or you think that's like nothing?
Well, it's all, again, it all comes back to inflation. Right now, inflation is the biggest topic. There's more people hurting, so they have to get inflation under control. That's the biggest thing hurting, the campaign right now, and anybody who's in office. If we don't get inflation under control, they're all out. There's no way they're winning re-election with 6, 7, 8% inflation. So wealth destruction is another conversation. Yes. So 2 years from now, inflation should arguably be under control. So that's when the Fed can come back in and pump the markets and build everybody's portfolio back up and increase housing and drop interest rates and do all that. So they definitely could pivot towards well, I guess next year is you start the election year cycle going into the following year. So it all just depends on inflation. That's the big caveat.
Sure. What's happening in real estate? Are we seeing home valuations rise, going down? Is it a buyer or seller's market? And maybe you could talk about a bit of your strategy.
Yeah. So, real estate is obviously hyper local, and every area is different. Every state, every city, every county, every, neighborhood, street, and block, So as a national housing market, let's just talk about the national housing market. We are seeing prices come down. We're seeing, inventory rise. We're seeing mortgage applications drop. Home builders all across the country are all reporting, zero traffic, no showings. Contracts are falling out because, rates are 2% higher than they were, 3 months ago. So people that contracted to buy a house at 500,000 3 months ago can't qualify now. Based on interest rates. So, the purchasing power of the house buyer has dropped by $100,000 on an average house in the last 3 months, and they just can't qualify. So that's affecting the housing market. The housing market, takes a little bit of time to unwind. So with interest rates where they're at now in the mid fives to upper fives, it's starting to have an effect. We're starting to see it. We're seeing it in commercial markets. We're seeing it in the housing market in a lot of different areas where, inventory is rising. Mortgage applications are down, refinances are down, interest-only loans and exotic loans are coming back, into play and things like that, so that people can afford the houses. But as rates get up into the 6, 7% range, which they probably could by the end of the year, if not will by the end of the year, that's when you'll see real damage, and you'll see a real, much faster, rapid correction in housing prices. But, again, pre-pandemic levels would be a 30% drop across the board from where we are right now in values.
Sure. Now, there's the common statement or well-known or investment principles of when there's blood on the streets, that's a time to, it's a great buying opportunity. I guess if you're a long-term holder, and that could be maybe for real estate, stocks, and crypto. Um, are you planning to, let's say we get to the levels you're talking about and things that are near bottom, are you planning to scoop up any of these respective assets and hold and flip them respectfully, as things start recovering?
Yeah. I've made my biggest moves in the bottoms March of 2008 and 9, March of 2020. So I'm waiting for this cycle, and it's going to be another huge opportunity once we get there. We're not there yet. I'm still looking for another 20-30%. Back to those pre-pandemic levels to kind of see where things fall. And we still have the war in Ukraine with potential escalation. We still have issues with China locking down more and disrupting supply, stuff. So I'm not in the camp that inflation's peaked. I know that there's some economists and politicians are saying inflation's peaked. Maybe a couple of people on Wall Street, economists and investment managers are kind of saying inflation has not peaked. We have not seen the effects of all of the disruption yet to come from everything that's happening from, the war and from China lockdowns, and things like that. And we haven't seen, the effects of a 0.5 point interest rate hike yet, from a Fed funds rate. So we're not there yet in that regard. So what I'm waiting for is, for things to level out. Again, I'm getting in and out. I'm working, making a couple of trades on these bounces. I got burned on Avalanche the other day. I thought Avalanche, might have had a local bottom was going to bounce, and it didn't. Yeah. It kept going. So I don't know. I think I bought at 58 or something like that, thinking it was going to bounce, and it never did. And it dropped some more. So I cut my losses there, got out, and then I'm in another trade right now that I know is going to bounce, and I'm waiting for that. And it's 20-30%, that I will net between these two trades. So, but I'm not looking at anything long-term, because the blood in the streets, a lot of people are looking at blood in the streets now. This is not the time for long-term, because if you go back and look at bear markets, and here's the other thing, a lot of people that are participating now, especially in crypto, a lot of younger people, you included, you've never seen anything but a bull market. You don't know what a high interest rate, zero Fed, bear market environment looks like. I mean, you weren't in the game 2008 and 9, were you?
No, I got into crypto around 2016.
Yeah, well, I just mean in general, and not just crypto, but financial markets, real estate, crypto, all of it. 80% of the people in the game have never seen anything but bull market straight up.
Sure.
So the view is skewed because that is your worldview, right? Assets only go up. So long-term, you're always and forever going to be okay. Well, if you look at the cycles and you go back and you say, okay, if I'm a long-term investor, let's take Kathy Wood. Kathy, we got a 5-year outlook. Now you're hearing her start to say 10. She was all about 5 years, but now you're hearing 5 to 10. So watch how messaging changes with these 5-year outlook, Wall Street people. Because if you go back and look at the dot-com bubble, it was 15 years or 20. It was either 15 or 20 before they got back to where it was before it tanked. 2008-9 housing market. It took, from 08-09 at the bottom, it wasn't until 2015 where markets got back to levels where they were before, the bubble burst. So it's not always 5 years. It's not always 10 years. And if you look at, even 2017, 2018, it took, a little time when the Fed raised last time to get back up. Then we had the pandemic and, all of this artificial inflation of the markets. But if the Fed isn't there pumping markets, it can take 10 to 15 years to recover from the top before we drop. So you need to make sure that you understand where we are in the cycle and where you're buying that blood in the street. And that's where that don't catch a falling knife comes from, is because there's no guarantee that you're going to get back to where you came from, number one. And there's definitely no way to know how long that's going to take without the Fed. Now, I'm going to caveat all this and say your number one signal is when the Fed comes out and says we're dropping interest rates and we're starting QE again, then it's bull market on, and that's the time to jump in hot and heavy, because that's your bottom indicator, and that it's just going to be off to the races from there. But without the Fed jumping in, you can't expect bull market on like we've seen, the last couple of times that they've jumped in.
And that's incredible insight and perspective. And your point is amazing that a lot of us haven't experienced true bear markets. And of course, I don't know what I was doing in 2008. I remember the markets crashed, but I wasn't investing. Um, but have they started something, a quantitative easing on steroids, where, and I could be totally off of this, they can't allow it to go as long as it has historically because we're just in a new paradigm. Um, like they've printed so much money like they've never printed before. Are they gonna and once again, I'm just throwing this out there. I don't know if this makes sense, but will they have to start this back up soon because they've changed the way the economy works?
So they've been on this path since 2008 and 9, but not to the degree since March 2020. Right. So they put as much in, and I think, from March 2020 until the end of the year when they said we're going to stop, and they didn't really stop until last month. They were still buying mortgage-backed securities, so they were still doing QE up until last month. They'd only raised rates 1/4 of a point until this month. So that was from 2008 and 9 until, now that we've been on this path, but 2 trillion was pumped in at the last 2 years versus a couple of trillion over 10 years. So during that 10-year period, we really didn't see hyperinflation. We really didn't see a lot of issues at the consumer level of the QE. We did in assets. That's what drove the stock market over that period. And that's what drove, the housing market because of low interest rates. Rates drop, prices go up. Rates go up, prices come down. So we did have severe inflation there. What's different this time is they put a ton in, for a very short period of time, because back then it looked like, well, the world was going to stop. So you had to replace GDP. Basically, is what they were trying to do is fund, GDP, for that period. That was the mindset and the contemplation they were after. And, what happened was with the pandemic, a lot of people left the workforce, a lot of them aren't coming back. So, labor rates have gone up. We've got the supply chain issues, lack of supply in every area now, except for the markets. There's too much supply there of liquidity. That's why you're having the deleveraging and the repricing, because now there's no liquidity. But that was a fire hose going after the markets. The rest of the markets now, there's not enough supply. So prices, are still an issue. They have to bring that back into check. And until that comes back into check, they can't start back up again, because then you'd be talking about 20% inflation, if they tried to jump in right now. So the Fed's kind of pinned to where they can't really do anything until inflation comes down. And then sure, they can, ramp it all back up. We can just do it all over again, and just kind of repeat the cycle, because they won't put 2 trillion in over 2 years, trillion a year. They'll go back to where we were 2008 and 9 and put a couple trillion in over, a course of time, and, a few $100 billion a month instead of, $1 trillion, a month.
Yeah. Just kind of uncertain times ahead.
Or a year. I'm sorry, a year, not a month.
I think final question here is this a period where cash is king and you want to be holding a large position in cash versus assets like we've seen, during the bull market?
So here's the other thing too. Cash is always king. Okay. So the dollar is the supreme, reserve currency of the world. Even right now, and even in war, when everybody said, oh, Bitcoin is going to replace the dollar because of, people over in Ukraine and Russians trying to launder money and all that, it ain't happening. Especially with what you're seeing right now. Dollar is always king in every environment, because without the dollar, you can't buy assets. So you have to have that, dry powder ready to take advantage of all opportunities, because even in bull markets, you get dips. So buy the dip, hold the rip in a bull market. So you want dry powder always to be able to buy the dips as you go along, in a bull market, or you buy, sell, buy more, sell, buy more, sell, versus bear market, buy, sell, you're out, buy, sell, that kind of thing. You're not trying to really increase. You're just trying to stay, build your cash at that point versus the asset, for a long-term hold. So, cash is always king in every market, but it's, exceedingly important now. And the number one thing that people make a mistake on in an environment like this, the biggest risk. So I talk about risk management a lot, and, that's what we've been talking about since, you and I started doing these, over the last, 3 or 4 months since the end of last year. We've been talking about risk management. preservation of capital. Why? Because the biggest risk out there, it's not what you lose. It's not having enough dry powder to enter the bull market and take part and participate in the bull market the next time. That's your biggest risk, because that's where generational wealth can be made for a lot of people, is in that bull market. And you're going to have a chance to do it all over again. We've got two examples, 2008 and 9, and we've got four traditional markets, and we've got what's recently happened. And then if you look at crypto, you got 2018. You can see that example. We've got here this last year. You can see the example. So we're heading back to the bottom where we came from, and it's going to be off to the races again, once we get through this.
For sure. Greg, always great and insightful information. Thank you so much for joining me today.
Yeah, thanks for having me.